Ladies and gentlemen, good day and welcome to Renaissance Global Limited Q1 FY25 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Jenny Rose from CDR India. Thank you, and over to you, ma'am.
Good afternoon, everyone, and thank you for joining us on Renaissance Global's Q1 FY25 earnings conference call. We have with us today Mr. Sumit Shah, Chairman and Global CEO, and Mr. Hitesh Shah, Managing Director of the company. We would like to begin the call with brief opening remarks from the management, following which we will have the forum open for an interactive question and answer session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the results presentation shared with you earlier. I would now like to invite Mr. Sumit to make his opening remarks. Over to you, sir.
Good afternoon, everyone. On behalf of Renaissance Global, I extend a warm welcome and thank you all for joining us on our earnings conference call for the first quarter ended 30th June 2024. I would initiate the call by taking you through a brief overview of the company's operational and business highlights for the period under review. Post that, Hitesh will give you a rundown of our financial performance. We started the year on a positive note, demonstrating stable performance and improvements on operating margins. Our consolidated EBITDA margins increased by 100 basis points year over year.
My God.
Sorry, who's this? Driven by exceptional results in our direct-to-consumer D2C segment. On a segmental front, our own brands D2C segment has demonstrated impressive growth, with revenue improving 30% year over year in Q1 FY25. The segment remains a key pillar of our growth strategy, and we anticipate it will continue to drive future success. We achieved an EBITDA margin of 7.6% in the own brands for Q1, reflecting a 340 basis points improvement year over year. We expect this upward trend to continue as we progress into the season. Even currently, our D2C brands command strong gross margins of 50 to 60%, and as we scale, we plan to enhance EBITDA margins to 15 to 20% over the next few years. Presently, our licensed brand segment have partnerships with global iconic brands such as Enchanted Disney Fine Jewelry, Hallmark, NFL, Netflix, Star Wars, and Disney Treasures. I'm pleased to report that we have exited the plain gold business based in Dubai, resulting in an overall inventory reduction of 75 crores from the peak of February 2024. This transaction closed August 1 of the current year and will be reflected in next quarter's financial results. The growing interest in lab-grown diamonds is reshaping the fine jewelry industry, and our D2C brands are at the forefront of this transformation by seamlessly blending luxury with affordability, given a strong emphasis on lab-grown diamonds. We've recently introduced a home preview and experience stores, allowing customers to buy before they try before they buy, which we believe will strengthen our market position in the next 2 to 3 years. Lab-grown diamonds now account for 55% of our D2C business and also prominently featured in our own brands and licensed brands. Rather than entering the increasingly competitive and price-sensitive field of lab-grown diamond manufacturing, we've strategically focused on building brands that cater to this demand. Our online platform offers a diverse selection of high-quality lab-grown diamonds from numerous suppliers, supporting our goal of providing exceptional value in the luxury market. Lastly, I'm delighted to share that Mr. Mehendale, Mr. Sathe, and Mrs. Pethe have gracefully completed their remarkable 10-year tenure as independent directors on 5th August 2024. We are profoundly grateful for their invaluable contribution and unwavering dedication, which have played a significant role.
Sorry to interrupt, sir. Your voice is breaking. Sumit sir, your voice is breaking. You're not audible. Hello.
Yes, am I audible now?
Yes, sir, you're audible now. Please proceed.
Building on this strong foundation, we're excited to welcome Mr. Deepak Chirdankar, Ms. Rupal Javeri, and Mr. Rahul Narang as new independent directors. Their extensive experience and valuable insights will greatly enhance our board and help us refine our corporate strategy going forward. In conclusion, positive demand trends reinforce our confidence in the long-term growth within the global branded jewelry market. We believe our strategy to capitalize on key partnerships, a strong distribution network, and D2C capabilities will drive revenue and profitability in the future. As we approach this upcoming season, a crucial period for our business, a dedicated focus on the branded segment and D2C initiatives ensures that we are well positioned to capitalize on opportunities and achieve continued success. On that note, I'd like to hand over the call to Mr. Hitesh Shah to discuss our financial performance during the quarter. Over to you, Hitesh.
Thank you, Sumit. Good day, everyone. We have reported a healthy performance during the quarter, driven by better performance in the direct-to-consumer segment. In Q1 of FY25, our total income decreased by 6% at rupees 447 crores compared to rupees 476 crores in the Q1 of FY24. On the profitability front, EBITDA expanded by 6.1% to rupees 39 crores in Q1 of FY25 versus 37 crores in Q1 of FY24. This translates into margins of 8.8% versus 7.7% respectively. Profit after tax in Q1 of FY25 stood at rupees 15.4 crores, up from rupees 14.2 crores in the same period last year, with enhanced contributions from our own brands, the direct-to-consumer business. Our US brands, a high-growth segment, reached revenues of 46 crores during the quarter, demonstrating a resilient business strategy and strong market expansion. While our direct-to-consumer India brand, Viraswa, with total 4 stores in Mumbai, Ahmedabad and Hyderabad, recorded revenues of rupees 4 crores in Q1 of FY25. In Q1 of FY25,
We have lost the connection for Mr. Hitesh Shah. Please stay connected while we reconnect them to the conference. Thank you. And thank you for patiently holding. We have the line for Mr. Hitesh Shah connected. Over to you, sir.
Thank you. So, in Q1 of FY25, our licensed brand business had revenues of rupees 86 crores with an EBITDA margin of 16.2%. While our own brand's direct-to-consumer business saw a revenue increase of 30%, reaching 50 crores in Q1, with EBITDA margins of 7.6% and improvement of 344 basis points. During the period, our studded jewelry accounted for 84% of revenue, with branded jewelry contributing 37% of the total studded jewelry revenue. Lastly, in terms of our balance sheet, our net debt to equity ratio stands at 0.31 in June 24 versus 0.28 in March 24 and 0.22 in June 23. Our total net debt stands at rupees 370 crores against rupees 233 crores in Q1 FY24. And our cash and bank balance and current investments stand at rupees 186 crores. Presently, inventory levels are elevated due to a strong order book, positioning us for revenue growth in FY25. In conclusion, we are pleased to have maintained a steady performance in the face of challenging conditions. Our solid balance sheet gives us confidence in our ability to navigate these challenges and look forward to stronger results in the upcoming fiscal year. On that note, I would now request the moderator to open the forum for any questions or suggestions that you may have. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. Participants, to ask a question, you may press star and one. First question is from the line of Saumil Shah from Paras Investments. Please go ahead.
Hi, sir. Good afternoon. Sir, if I see last 4-5 years, our revenues have been more or less in the range of 2,000 crore. In fact, it has gone down from 2,500 crores in FY19-20 to 2,100 crores in FY24. So, sir, wanted to know the reason for the same, and now what measures are we taking to improve our revenue and bottom line for this financial year? And how much growth can we expect in terms of bottom line for this financial year?
Thank you for your question. So, I think that the reason for the revenue growth not reflecting is a change in accounting policy in the current in the company. Prior to FY21, we were reporting revenue for the gold business on a gross basis, which was adding around 800 crores to the top line, which we started reporting on a net basis. So, some of the revenue growth not showing up is due to a change in accounting policy, and with the exit of the plain gold business, the reported revenue number will be lower. However, we're focusing on high ROE, ROCE businesses, which actually enhance the return on capital employed, and focusing on better quality businesses which improve profitability. While we are optimistic about revenue growth going forward, we've also undertaken cost control measures, which will result in an annual savings of 20 to 25 crores on an annualized basis starting Q3 of this financial year. So we're taking multiple measures, focusing on higher quality businesses, which are our direct-to-consumer businesses and branded businesses, to improve margins, and also focusing on cost control by reducing overhead in the company to get to our goal of double-digit margins. Thank you.
So, can we expect 15 to 20% growth in bottom line for this financial year?
I think it's a little bit early to say. That's our endeavor. That our goal would be to grow in double digits. I think that we have low visibility on the season so far. We should be able to give much better guidance in the following quarter, as the Christmas season is a crucial part of our profitability for the year. So Q3 would be a good time end of Q2 would be a good time for us to give visibility on the year. Right now, because of the US macroeconomic situations, the visibility is a little bit limited. Our endeavor is to definitely grow in double digits, if not through revenue growth, by cost control measures and reducing expenses.
Okay. And so I wanted your thoughts. Why do we have multiple websites for different licensed brands? Can we not have just a strong website and all the brands on the same site so that we can save a lot of advertising and SEO spends? Because to promote so many websites and to rank them on Google takes a lot of time and as well as spends. So just wanted your thoughts.
Yeah, so we are working on this initiative. We plan to launch a consolidated website with all of our licensed brands called Wonder Fine Jewelry, which will be a brand owned by us in November of this year. So we're aware of this fact, and we agree with your sort of observation. And it's obviously permissions from the various license holders who have conflicting interests. So we've managed to work through all of this. Our tech team is currently hard at work getting this done, and we plan to launch this in Q3 of this fiscal year.
Yes, because that should save a lot of savings, in terms of SEO spends and everything.
That's right.
Yeah. And so my final question, do we have presence in online D2C business in India?
We do not. Currently, our India retail business is driven through our physical stores, which is Irasva. We don't have an e-commerce business in India at the moment.
And any plans to enter?
So our plans are to promote With Clarity globally. Currently, With Clarity is only in the US, and we plan to launch UK in India in the coming quarters. So we do plan to. The website is currently ready. We haven't started spends yet, but lab-grown business will be promoted in addition to the US in other markets as well.
Okay. That's it from my side. Thank you, and all the best for your future quarters.
Thank you.
Thank you. Before we move to the next question, a reminder to the participants: to ask a question, you may press star and 1. Next question is from the line of Pawan Kumar from Ratnatraya. Please go ahead.
Sir, regarding the lab-grown diamond business, what is the current demand scenario in our key markets? And also, how is this particular business scaling up? Can you throw some light on that? Also,
Sorry, your voice is muffled. Could you please repeat the question?
Sir, I wanted to understand about the lab-grown diamond market. How is the business scaling up, and what are the key markets we are looking at to get this business into? I just wanted an idea on the lab-grown diamond business.
Yeah, sure. So, the lab-grown diamond business is growing rapidly and seeing increased acceptance by the customer primarily in the US markets. If you see the lab-grown penetration of our direct-to-consumer business is already at 55% of the total and is likely to increase even further. It's a smaller component of our B2B business, but the contribution has increased by 50% year over year. So I think that we see increased penetration and acceptance by customers of lab-grown diamonds, and we see this trajectory continuing for the next 4 or 5 years.
Okay. And in B2B also, do we expect a significant amount of change in terms of it moving towards lab-grown diamonds?
Yeah, we are seeing that. I think that it's going to be slow transition because a large component of our sales comes from existing SKUs which are already in lab-grown diamonds. A lot of the new introductions that we are doing with our key partners are in lab-grown diamonds. So it would be a gradual process. The change over to lab-grown diamonds is not going to happen in 1 or 2 quarters. But slowly but surely, we are seeing an increased penetration of lab-grown diamonds with all of our key partners worldwide.
And are we going to use any of our brands, something like an Eraswa, to get into this?
We are already selling lab-grown diamonds through the 4 Eraswa stores. We've launched 1 month ago, and we should have more feedback to share in the coming quarters on the success of lab-grown diamonds in India.
Okay. And can you just give us an idea about how is the overall demand scenario? Sir, you just mentioned you are not sure right now, but US and European markets, how are they right now, and what do you overall feel about it specifically?
Yeah.
I think
what we've
get a bit of clarity.
What we've noticed is slightly shorter lead times. I think because of the uncertainty, customers are placing orders closer to delivery time. So currently, we don't have full visibility for Christmas for the October, November, December timeframe. I think that in the next 30 days or so, there should be a lot more visibility. Our current order book at the factory is extremely strong. For July was a strong month. August was a strong month. But we don't have too much visibility beyond September at the moment because customers are in the process of finalizing their holiday and Christmas orders, and within the next 30 days, there should be a lot more visibility.
So generally on the factory floor, how much in advance how many months advance orders do we have to know of?
It's usually 6 weeks.
Achha, 2 months broadly.
Yeah. 6 to 8 weeks. We're seeing a trend more towards 6 weeks currently. It used to be 8 to 10 weeks, but I think that customers are placing orders closer to the time they want. So the lead times generally are now 6 weeks. So we have a very clear visibility for September. Beyond September, the visibility is a little bit limited because customers haven't yet placed orders for the key holiday season.
But this would be a normal scenario, right, sir? For it, every year, maybe before 2 months, 3 months, you would not know the orders, right? Or is it like you are saying we should have known the orders for September by now, but we are not able to yet gauge that? Is that what you are saying?
I think it's a normal course of business. I think that usually between 15th August and 15th September is when a lot of the key holiday orders are placed. However, we are seeing maybe a 1 or 2 week delay compared to historical standards because of the uncertainty that customers are feeling. However, it's normal course of business to place key orders between August and September.
Okay. And can you give us an idea of what is U.S. as a market's overall contribution as compared to other regions?
So currently for us, U.S. would be between 65 and 70% of our overall sales.
Okay. And Europe?
And the proportion would increase after the exit of the gold manufacturing business in Dubai. So it will be probably closer to 75% or so once. The breakup will be 75% US, 25% other markets. As of August 1, we've signed an agreement to sell our gold business in Dubai, which was a low ROE, ROC business. So I think with the exit and sale of that business, our proportion of US to non-US markets would be approximately 75-25.
Okay, sir. Thank you, sir. That was good.
Thank you. Participants who wish to ask a question, you may press star and 1 on your touchtone telephone. Next question is from the line of Ritesh Gandhi from Discovery Capital. Please go ahead.
Yeah, hi, sir. Just want to understand if you could just throw some light on the growth, the gross margins, the acquisition costs, and some of the other metrics related to your online look. Actually, I mean, in a little bit clarity business.
So,
how is it trending
the gross margins
to the last few quarters? Yeah.
The gross margin, on D2C in general is between, 50 to 60%. I think that customer acquisition costs and all of those are relatively confidential, pieces of information that we haven't shared. But, our e-commerce businesses are profitable. I think a drag on our branded segment is currently our India retail business, which is not yet profitable. I think X of that, we're very focused on sort of making money on our first order on our e-commerce businesses, which we've always done from day one. And I think that we maintain a healthy profitability ratio on our e-commerce businesses.
And how's the growth been in terms of over the last few quarters?
Yeah, so I think we've maintained a growth of about 30% this quarter, and our expectation would be growth for this year in the 20 to 30% range for our brands in the US.
Got it. And what you're indicating is that even as standalone, your e-commerce businesses are profitable and aren't just dragging down the profitability in any way.
Yes, that's right. I think we've in our slide on slide 9, we've sort of disclosed the EBITDA margins. We're at about 9% margin on our brands, which are US owned brands, and we expect that to be in that 15 to 20% range over a 2 to 3 year time frame. So our brands are sort of subscale right now. As we get operating leverage, we expect the margins to go up.
Got it. And we expect the growth to kind of continue given how small piece of the market share we have right now.
That's right. That would be our current view, that there is a long runway for growth for these businesses in the US.
Got it. So even in the event of an economic slowdown or whatever, you don't see too much of an impact here because our market share is quite low.
That's right.
Got it. And, is there any actually light you can throw on the India business, how the initial traction has been effectively, the existing losses which we are making right now, and the overall strategy?
Yeah. So I think, we've sort of highlighted the India business. It's grown well from, 7 crore annual run rate to a 22 crore revenue last year. We expect that to be between, 30 to 32 crores in the current year. I think that, as we cross around 40 crores of revenue, the business would kind of break even and be profitable. Our expectation would be for the business to break even and be profitable in FY26. In the current year, at a 30 crore revenue, we will still continue to lose some money, but I think we're seeing very positive momentum and positive same-store sales growth. So we're optimistic about the India retail business, and also the introduction of lab grown, I think, will add an impetus for the business to grow. The gross margins on the lab grown business in India also are healthier than the natural diamond business, which will help improve profitability of the India business going forward.
Good. And right now, how much would be the split of the lab grown as opposed to the natural in your stores?
In India, it's, we just launched lab grown diamonds last month, so virtually zero. Right? So we launched lab grown diamonds in our Iraswa business less than 30 days ago.
Got it. All right. Thank you. I'll just rejoin the queue and maybe take some questions offline. Thanks.
Thank you. Next question is from the line of Yogesh Bhatia from Sequent Investments. Please go ahead.
Hi, good afternoon, sir. So, sir, actually, I am fairly new to the company. So, of the total 445 crore sales that we have done in this quarter, 73 crore is towards gold, and the remaining is to jewelry and diamonds. So, in this, what is the breakup for lab grown? I think mainly lab grown is being sold in customer and licensed brands. So, what is the breakup? How much percentage is lab grown diamond sales?
I think it's been disclosed in our presentation. Around 15% of our studded jewelry business is lab grown.
So studded jewelry, 15% of studded jewelry. That means should I add customer, licensed brand, and US-owned websites?
Yes, all of it. Yes, that's right.
All three. So 15% of that. So that is around 50-55 crore quarterly lab grown diamond sales is there.
That's right. That's right.
Okay. And this is sold via your different, basically either D2C or B2B or customer brands.
Both. Yes.
Correct?
That's right.
Now,
That's right.
with Clarity is going to be your own brand.
That's right.
And that we are going to sell in the US. It is a D2C brand or it is a B2B, or how does that work?
It's currently D2C, and it's classified in our earnings presentation in our US-owned websites.
Okay, so it's a D2C brand, and right now there is no sales as such that we have started with that in that brand right now.
No, that brand is already in the 46 crores. We've acquired it 2 years ago, and it's an ongoing business.
Okay, so how much would be sales of with Clarity in the 46 crores?
We haven't disclosed that because we've got 3 brands in the US. So
okay.
We haven't disclosed that, and I think we'd like to keep that confidential for.
No problem.
Competitive.
So, sir, where do you see the traction coming? Do you plan to sell to the big US retailers, or do you plan to go, with your own brand, with Clarity, and focus more on that and sell it through our websites and through our channels?
So currently, we've got both businesses, right? So our diamond jewelry business, which is around 370 crores, is a combination of our own brands, licensed brands, as well as sales to large retailers. So our focus really is licensing and concentrating on our retail partners, large retailers in the US, as well as selling it direct to consumer. So we do both, and we continue to plan to focus on both.
Okay. The reason I'm asking is because the margins that you make in a licensed brand is different from what you make in your customer brands. So, yes. As an investor, if you sell 235 crore customer brands, you make half the margin, whereas in licensed brand, you make double of that. So, that's what I want to know, which is the focus area and why do you think that should grow? in the sense, because I'm sure the market is crowded by other players also.
Yeah. So, the customer brand segment has sort of remained stagnant for a number of years. It's not a growth area of the business, and the business is a low ROE, ROC business for the company. We've grown the licensing business and the direct-to-consumer business, and clearly from our actions that we are taking in terms of, exiting the plain gold business, which is a commoditized business, our endeavor is really to move more towards a differentiated branded and licensed brands business. I think that it's a journey that we've got to embark on by not shifting things too rapidly. But clearly, the focus of the company is on, improving margins and moving to a more capital efficient structure, which we plan to do over a number of years.
Okay. Okay, sir. I'll get back in the queue for other questions.
Thank you. Next question is from the line of Chirag Vekharia from Budrani Finance. Please go ahead.
Hello.
Yes. Hi, Chirag. Go ahead.
Yeah. So just wanted to understand of the, if I take the total jewelry sales of say 370 crore, excluding your plain gold, of this 15% is on diamond, correct?
Yes, that's right.
Okay. Now, sir, I just wanted to understand how are the margins in lab-grown diamond and natural diamond, sir?
So, lab-grown diamond margins are slightly higher than natural diamond margins from a gross margin perspective. However, it does come with an increased inventory risk as lab-grown diamond prices have been going down. I think that with the increased penetration of lab-grown, margins should go up over time. And I think that a key driver of increasing margins for our company is also cost optimization. So we're cognizant of the fact that our cost structure is a little bit on the higher side, and with a 1,700 crore diamond jewelry business, our margins should be in the double-digit range. So I think that structural shift more towards lab-grown diamonds and becoming more efficient on a cost side for us as a company, a combination of the two things should help us grow margins, not just the shift towards lab-grown diamonds.
Yes, sir. So what I wanted to understand is incrementally, say people were to shift to lab-grown diamond, then the margins you still think can go to double digit, even by the shifting of the preference?
That's right.
Okay, sir. Okay, thank you.
Thank you. Next question is from the line of Rohit Shah from Ladder Up Wealth Management. Please go ahead.
Hello, am I audible?
Your voice is very low.
1 second. I think this should be better.
Yes, please proceed.
Yes, so I had a couple of questions. One is that in quarter two, now that you've done with 2 months, what is the kind of demand environment that you're seeing, especially in the US, for jewelry buying and discretionary spending that has generally been subdued? That is question number 1.
Yeah, so there's no question that discretionary spends are under pressure in the US. I think that if you look across any single category, whether it's luxury or any kind of discretionary spends. So, to answer your question, that US discretionary spends are under pressure because of high inflation over the last couple of years. However, in our business in particular, we've seen relatively strong factory order book for July, August, and partially into September. We don't have too much visibility for the season, so hard to comment on what the Christmas season will look like due to a little bit of uncertainty. Our endeavor obviously is to focus really on the growth areas, which is the direct to consumer, where we have a small market share and we will continue to grow, and as well as penetrating deeper into lab-grown diamonds, again, a new category where customers are gravitating towards those segments. So, macro picture, US demand is definitely subdued at a macro level. At a company specific level, I think the first quarter has been a little bit subdued. However, the order book does continue to remain healthy, for the short period of time. However, a little bit early to have visibility on the Christmas quarter because we don't have full visibility yet.
Okay, sir. My second question is that, how has been the response to the new Warner Brothers and DC jewelry collection that you've, I think launched last quarter or something. And secondly, we are also testing some Barbie collection licensed brands. So, has that been rolled out and how has been the response to that as well?
So, I think that so far we've seen a lot of success, primarily with the Disney princesses, and that remains the mainstay of the business. I think that, we've seen very moderate success with the Barbie collection or with some of the other newer licenses. So I think that the strategy of the company going forward is really going to be to focus on what's working and grow that, because the addressable market for the brands that are working and successful is much larger than what it is. So I think our strategy in order to improve margins is to really focus on the brands that are working and not expand the universe of brands too much. So the focus is really going to be on Disney princesses, Disney treasures, Hallmark and Star Wars. These are all brands that are doing well and, with focus will continue to grow. Some of the other marginal brands are going to sort of not be focused on, as our endeavor is really to take our margins from the 15-16% to even higher levels by focus on a few successful brands and make them into power brands.
Thank you, sir.
Thank you. Participants, to ask a question, you may press star and 1. Next follow-up question is from the line of Saumil Shah from Paras Investments. Please go ahead.
Hi, thanks for allowing me a follow-up. You just mentioned that we exited plain gold business. So this quarter we have done about 73 crores of revenue. So are you saying that from next quarters it won't be there? Is my understanding correct?
That's right. Yes, that's correct. We will have revenue in the month of July. August 1 onwards, the revenue will not be there, and correspondingly, it will have a 2 to 3 crore impact on the quarterly EBITDA. However, the business's return on capital employed was very close to cost of capital and cost of debt. So the impact on the bottom line should be minimal to almost zero. And this additional 70 to 80 crores of liquidity that we would get would be used in lowering debt levels of the company going forward. But to answer your question, the revenue of 70 crores will go away next quarter, and you will see a decline in revenue due to the exit of the plain gold business.
Okay. And what is our D2C online business? You've mentioned US owned brands is somewhere 50 crores?
That's right. 50 crores, 46 crores this quarter.
US owned website for online sales. And the licensed brands D2C is how much?
We've not given the breakup. I don't have the numbers available off the top of my head, but we can have the IR team submit it.
Okay. And even that is growing at the rate of 20-25%?
That's right. That's growing at a slower rate because they are more mature businesses, but they are growing, yes.
Okay. Yeah, thank you.
Thank you. Ladies and gentlemen, to ask a question, you may press star and 1. As there are no further questions, I would now like to hand the conference over to the management for the closing comments.
Sure. Thank you everyone for joining us on our quarterly conference call. Look forward to seeing you again on the Q2 FY25 call. Thank you and have a great day.
Thank you.
Thank you very much. On behalf of Renaissance Global Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.